National income serves as an instrument of economic planning. National income is one of the most significant macroeconomic variables. Nobel laureate Simon Kuznets first introduced the concept of national income. In common parlance, national income means total money value of all final goods and services produced in a country during a particular period of time, 1 year. The labor and capital of country acting on its national resources produce a certain net aggregate annually. This is the true net annual income or revenue of the country or national dividend. Alfred Marshall. The welfare of a nation can be scarcely be inferred from the measurement of national income as defined by the GDP. Goals for more growth should specify of what and for what. The net output of communities and services during the year from the country's production production system into the hands of the ultimate consumers. Simon Kuznets. Basic concepts of national income. The concepts are GDP, GNP, NNP, and NNP factor cost. GDP is the total market value of final goods and services produced within the country in a year. Net domestic product is the net output of the economy during the year. Some of the country's capital equipment wears out and becomes outdated each year during the production process. Net domestic product is equal to GDP minus depreciation. Gross national product is a total measure of the flow of final goods and services produced at market value resulting from current production in a country during a year, including net income from abroad. GNP includes value of final consumer goods, gross private domestic consumption. Gross private domestic investment, which is called gross investment. Residential construction inventories of finished products and goods and services produced or purchased by government. G. Net exports of goods and services, such as difference in the value of exports and imports, X minus M. In the net factor incomes from abroad received from abroad by residents, by normal residents of India, and factor incomes paid to the foreign residents by factor services rendered by them in domestic service rendered in India, R minus P. GNP at market prices means gross value of goods and services. So C plus I plus G plus X minus N plus R minus P is GNP. So net national product at market price refers to the net output of the economy. GNP is obtained by deducting the value of depreciation allowance from GNP. The NNP at factor cost refers to the market value of the output, whereas NNP at factor cost is the total output of income made to factors of production. NNP at factor cost is equal to NNP at market prices minus indirect taxes plus subsidies. Personal income is the total income received by individuals of the country. Personal income is derived from national income by deducting undistributed corporate profit and employees' contribution to social security schemes and adding transfer payment. Disposable incomes is the income of the individuals after the payment of income tax. Per capita income is the average income of a person in a country in a particular in a particular year. Per capita income is equal to national income by population. Real income is the nominal income is national income expressed in terms of general price level of a particular year. In other words, real income is the buying power of nominal income. National income is the final value of goods and services produced and expressed in terms of money, but it does not indicate the real state of the economy. The real income is real income at constant price is equal to national income at current price divided by P1 by P2. GDP deflator is an index price of goods and services produced in GDP. GDP deflator is equal to nominal GDP by real GDP into 100. Methods of measuring national income. There are three methods: production method, for income method or factor earning method, expenditure method. Output is equal to income is equal to expenditures must hold for all these methods. This equation must hold. GDP consists of consumption, government spending, investment spending, change in value of stocks, exports minus imports. GDP is equal to known as aggregate demand. GDP is factor incomes. Income from people in jobs and in self-employment, wages and salaries, profits of private sector business, rent income from the ownership of land. GDP value of output is value added from each of the main sectors. These sectors are primary sector, secondary sector and tertiary sector. The product method measures the output of the country. Under this method, the gross value of output from different sectors like agriculture, industry, trade and commerce is obtained in the entire economy during a year. The value obtained is actually called GNP at market prices. The value of final product is derived by summation of all the values added in products produced, product is services. In India, the gross value of the farm output is total production of 64 agriculture commodities is estimated. The output of each crop is measured by multiplying the area sown by the average yield per hectare. The total output of each commodity is valued at market prices. The aggregate value of total output of these 54 commodities is taken into measure the gross value of agricultural output. The net value of the agricultural output is measured by making deduction for the cost of seed, manures and fertilization, market charges, repairs, depreciation from the gross value. The gross values of the output of animal husbandry, forestry and mining and factory establishments are obtained by multiplying the estimates of total production with market prices. Net value of output in the sector is derived by making deductions for cost of materials used in the process of production and depreciation allowance. Net value of each sector is measured in this way, indicates the net contribution of the sector to the national income. The income method, factor earning method. This method approaches the national income from distribution side. Under this method, national income is calculated by adding up all the incomes generated in the course of producing final product. The enterprises are classified into various industrial groups. Factor incomes are grouped under labor income, capital income and mixed income. Labor income are wages, salaries, employers' contribution of social security, fringe benefits. Capital income is profit, interest, dividend, royalty. Mixed income is farming, sole proprietorship and other professions. National income is calculated as domestic factor plus uh, net factor income from abroad. W is for wages or rent, high interest plus pi profits plus exports minus imports from income from abroad. So national income. This method is adopted for estimating the contributions of the remaining sectors: small enterprises, banking and insurance, commerce and transport professionals, liberal arts and domestic service, public authorities, house property and foreign sector transaction. The expenditure method, outlay method. Under this method, the total expenditure incurred by the society in a particular year is added together. To calculate the expenditure of a society includes personal consumption expenditure, net domestic investment, government expenditure on consumption as well as capital goods and net exports. GNP is equal to private consumption plus private investment expenditure plus government expenditure plus net exports X minus N. So like precautions like expenditure made on second-hand goods should not be included for the expenditure method. Purchase of shares and bonds. Expenditures on purchase of old shares and bonds in the secondary market should not be included. Transfer payments, expenditures incurred by the government like old age pension should not be included. Expenditure on intermediate goods, expenditure on seeds and fertilizers for farmers, cotton and yarn by textile industries are not included to avoid double counting. That is only expenditure on final products are to be included.